Let's play a quick game. Imagine you had invested just $100 into the S&P 500 back in 1990. Today, without doing anything, that same $100 would be worth over 2000. Now, imagine if you had invested $100 every month since then. We're talking about turning a few coffees a week into hundreds of thousands of dollars. That's the power of investing. And it's not magic, it's math. Welcome back to Aaron's Money Manual, where we take control of your finances one step at a time. Today, we're breaking down the mysterious world of investing, what it is, how it works, and how you can start even if you've only got a few bucks to spare. So, what is investing really? Investing is basically putting your money to work for you, like planting a seed that grows into a tree over time. When you invest, you're not just saving your money, you're giving it a job. Instead of your cash sitting in a savings account earning a few pennies in interest, it's being used to help businesses grow, governments build, or real estate develop, and in return, you earn a piece of that growth. In short, saving protects your money, investing grows your money. Here's the thing, inflation quietly eats away at your money every year. If inflation is around 3%, that means something that costs $100 today will cost $103 next year. So if your savings account only earns 1% interest, you're actually losing 2% of your money's buying power each year. Investing helps you stay ahead of inflation and actually build wealth over time. It's how ordinary people reach goals like buying a house, sending kids to college, or retiring comfortably. Now let's talk about one of the most powerful forces in finance, compound interest. If there's one phrase that defines investing, it's compound interest. Compound interest is when your money earns returns, and then those returns start earning returns too. It's like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and grows faster. Let's put some numbers to it. If you invest $1,000 and it grows by 8% a year, you'll have $1,080 after the first year. The next year, you're not just earning on your original 1,000, you're earning on 1,080. After 10 years, that $1,000 turns into over 2,100. After 30 years, over 10,000. That's why investing early matters. Time multiplies your money's potential. It's not about timing the market, it's about time in the market. All right, so what can you actually invest in? There are tons of options out there, but here are the main ones you'll hear about: stocks, bonds, funds, and real estate. When you buy a stock, you're buying a small piece of a company. If that company grows and becomes more profitable, the value of your shares increases. It's ownership, even if it's just a tiny fraction. Bonds are like loans you give to governments or corporations. They pay you back later, with interest. They're generally lower risk, but also lower return than stocks. Funds, like exchange traded funds or mutual funds, are basically baskets of investments. Instead of buying one company's stock, you can own hundreds at once. It's a way to diversify, spreading out your risk. Most beginners start here because it's simple, automatic, and less risky than betting on a single company. And then there's real estate, owning property or investing in real estate funds. It can provide both income and long-term growth, but it usually comes with higher upfront costs and responsibilities. Now, all these investments have one thing in common: the trade-off between risk and reward. Generally speaking, the higher the potential reward, the higher the risk. Stocks, higher risk, higher reward. Bonds, lower risk, lower reward. That's why most investors combine different assets to balance growth and stability. This mix is called diversification, and it's your best friend. Because if one investment drops, another might rise, keeping your overall portfolio steadier. Now, quick question. If I told you that one simple investing mistake could cost you hundreds of thousands of dollars over your lifetime, would you want to know what it is? It's not starting soon enough. Every year you wait, you lose out on compounding power that can never be recovered. So, if you've been waiting for the right time, this is your sign. Because the best time to invest was yesterday, and the next best time is today. So, how do you actually get started with investing? Here's a simple plan to start confidently, even if you're brand new. First, make sure your financial foundation is set. That means you've got a budget that works, high interest debt under control, and an emergency fund with at least 3 to 6 months of expenses. Investing is powerful, but it's not a substitute for stability. It's what comes after your foundation is set. I spoke about all of these steps in my previous videos, so if you haven't already, be sure to check those out to get caught up before jumping into investing. Next, decide on your goals. Ask yourself, why am I investing? Is it to buy a home, start a business someday, build long term wealth? Your goals help determine how much risk you should take and how long to invest for. Then, pick an investing platform. You don't need a fancy broker or thousands of dollars. There are plenty of apps and platforms now where you can start with as little as $5. Some platforms let you invest automatically, others give you full control. Choose what fits your style. Automated if you like set it and forget it, manual if you like to be hands on. Personally, I use Fidelity as my investing platform because I find it efficient, easy to navigate, and reliable for long term investing. After that, choose your investments. For most beginners, the best place to start is a broad index fund, something that tracks the overall stock market, like the S&P 500. You can also mix in bonds or other funds depending on your comfort with risk. And remember, start small but stay consistent. You don't need to invest a fortune to build one. Start with what you can afford, even $50 or $100 a month. The key isn't the amount, it's consistency. Set up automatic contributions so investing happens without thinking about it. That's how habits form and wealth builds. Now, how much should you invest? A good general rule is to aim for 15 to 20% of your income. But don't panic if that's not realistic right now. Even 5% is better than zero, because your investing journey isn't about perfection, it's about progress. As your income grows, you can increase that percentage over time. Before you dive in, let's talk about a few common mistakes new investors make so you can avoid them from the start. Mistake number one, trying to time the market. Nobody, and I mean nobody, can predict short term ups and downs consistently. Focus on time in the market, not timing the market. Mistake number two, investing money you'll need soon. If you'll need the money within a year or two for rent, tuition, or emergencies, don't invest it. Investing is for long term goals. Mistake number three, ignoring fees. Some funds or apps charge hidden fees that eat into your returns. Always check the expense ratio. Lower is better. Mistake number four, panic selling. Markets go up and down. That's normal. Don't sell out of fear when prices drop. If you stay invested, history shows that markets recover over time. Let's also touch on diversification and something called asset allocation. Diversification means spreading your money across different investments to reduce risk. Asset allocation is simply deciding how much of your portfolio goes into stocks, bonds, and other assets. Younger investors usually have more stocks because they have time to ride out market swings. As you get older, you might shift toward more bonds or stable investments for safety. The mix that's right for you depends on your goals, your comfort with risk, and your timeline. Many investing platforms can even help you pick an allocation automatically based on those factors. Now, you might be wondering, what about retirement accounts like 401ks or individual retirement accounts? Those are powerful investing tools, but we'll cover them in their own dedicated video soon. For now, just know they're tax advantaged ways to invest for your future, so keep your eyes peeled for that upcoming episode. At the end of the day, successful investing is more about mindset than math. It's about patience, discipline, and long term thinking. Wealth doesn't come from chasing quick wins, it comes from steady habits, smart decisions, and letting time do the heavy lifting. Don't compare your progress to others. Just focus on taking the next right step, one investment at a time. And that's Investing 101, your crash course on how to make your money start working for you. If you found this helpful, please like, comment, and subscribe to Aaron's Money Manual, where I'll continue posting regular videos to help you take control of your finances one step at a time. If you haven't yet, please check out my recent video, Savings 101. It ties perfectly into what we've talked about today and will give you a deeper understanding of how to build the foundation before you invest. Thanks for watching, and remember, the best investment you can make is in yourself.